Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed on Nasdaq. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Joining us this Wednesday afternoon, we have Ryan McCormack, factor and core equity strategist at Invesco, to discuss Nasdaq-100 weekly performance. And Ryan, when we talk about one of the best performing indexes, it is not unusual to see some volatility or pullbacks in the Nasdaq-100 or any index for that matter.
Yeah, that's for sure. And you know, looking for the week, we have QQQM and QQQ down 4%. That's versus the S&P 500 down 2.87, and S&P 500 value down 1.54%. Really just a tough week as higher rates and potential increased Fed action or worries around increased Fed action really weighed on the growth arena, particularly tech stocks. While we saw some lackluster bank earnings reports weighing on the value side of the equation, although this morning's reports from Bank of America and Morgan Stanley were much more optimistic. Today has been a very choppy session. We saw a very strong reversal, just before 11:30 a.m. So at that point, the Nasdaq-100 briefly fell into correction territory, so down 10% from its November 19th high. At that point, we saw QQQ trade higher and then head back down towards correction territory. So I think your comments on volatility and choppiness are certainly holding true today.
And Ryan, this is something that we've seen repeat historically, not just over a longer term, but something even a little bit shorter term. Even just last year, you can see some of the trends and some of the patterns on the charts that look really similar to what we're seeing now.
Yeah, and it's funny, not even a year ago, we saw QQQ decline by nearly 11%, against the S&P 500, which fell by around 2.8%, and the S&P 500 value, which at the time was actually up by 4%. And at the time we talked about pullbacks and corrections. They happen. It's arguably healthy for the market. It's something that maybe we haven't been used to in recent years, but it's something that I think has always been there in the markets and is healthy for markets to see that sort of action. As we look back through that time from kind of mid-February through early March of last year, we saw value stocks trade higher, being led by energy and financials, right? As worries around inflation and higher rates kind of drove market action. In this most recent pullback from November 19th through today, arguably, we're seeing value outperforming, being led by energy and financials as worries around inflation and higher rates have driven market action. Right, so it's a very similar story, just plus 1 year. Where now, there are some nuanced differences. We're closer to Fed liftoff than we this time than we were last year. We've seen inflation linger for longer than the Fed certainly had anticipated versus last year, and at higher levels. But the economy remains on pretty firm footing. Throughout last year, on these worries of higher costs, we saw profit margins remain at very high levels. Companies pushed a lot of those rising costs for goods onto the consumer, and largely over the past year, the consumers handled it. Some of the spillover effects from COVID and the societal changes that we've seen, driven by intervention from the government, was higher household savings rates and checks from the government, which kind of have allowed the consumers to largely weather these higher prices. And kind of looking at today, a good example was Procter & Gamble's earnings report. They showed that price increases propelled Q2 revenue. It propelled the companies to raise its full year revenue forecast. So, despite kind of these lingering higher prices, we're seeing margins remain pretty high and largely companies reporting decent earnings. But that being said, we look ahead for 1 week from today. We've got a Fed meeting, right? So lots of attention around that. Any updated policy or more hawkish language. Beyond that, we have earnings seasons coming up, which is always very important, particularly for Nasdaq-100. Important to keep an eye on the profit margins in this inflationary environment. Scheduled to start next Tuesday preliminarily with Microsoft, Wednesday with Tesla, and Thursday with Apple, followed by a number of other heavyweights in early February.
Right. And I'm glad you brought up earnings here before we get to our last point, Ryan, because when you think about, we get the value trade, right? We know where valuations were in the higher growth names. We saw that rotation starting, end of 2021 into energy, into financials. What's interesting though is financial earnings have been relatively lackluster, and expenses are a big part of that. So we get the valuation trade, but what's happening under the hood with fundamentals really is telling the story, at least this week, when you think about financials. So I'm really curious to see just how these tech growth companies perform in their earnings report. And of course, guidance is going to be really key there too, because under the hood, the fundamentals might not have changed as much as the valuation story has. So that was a good point that you had brought up. To wrap up here in the last minute, let's take a look at your last chart and see what sectors have been leading and detracting from performance.
Yeah, so with growth out of favor, we saw tech and discretionary both down over 4%. Communication services down over 3%. From the S&P, to your point, right? Financials earnings were somewhat lackluster. We actually saw them in the red versus energy, which still remained in positive territory for the week. From a company news perspective, some Nasdaq-100 merger and acquisition talk with yesterday Microsoft reporting that it will buy Activision Blizzard for almost $69 billion in cash, which represents about a 45% premium to Friday's close price. Comes during a pretty tumultuous time for Activision, with lawsuit filed over the summer around gender bias and sexual harassment. But from a Microsoft perspective, getting shares at a kind of $95 at one point last year in February is over $100, but it's his biggest acquisition, and it will make the company the third largest gaming company in the world. I think it comes at a pretty important time as Microsoft looks to expand and start to increase their offerings, particularly in the world of mobile gaming and as the metaverse continues to expand.
All right, Ryan, appreciate the insight. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.